What is long and short in Forex? What is margin? How to calculate profit and loss in Forex. Welcome to Forex Sonic, Forex Audio Library. Today we will learn Chapter 2 named The Mechanics of Currency Trading, 15 to 17 pages from Currency Trading for Dummies by Mark Galant and Brian Dolan. So let's start. The long and the short of it. Forex markets use the same terms to express market positioning as most other financial markets. But because currency trading involves simultaneous buying and selling, being clear on the terms helps, especially if you're new to financial market trading. Going long. No, we're not talking about running out deep for a football pass. A long position, or simply a long one, refers to a market position in which you bought security. In FX, it refers to having bought a currency pair. When you're long, you're looking for prices to move higher, so you can sell at a higher price than where you bought. When you want to close a long position, you have to sell what you bought. If you're buying at multiple price levels, you're adding to longs and getting longer. Getting short. A short position, or simply a short, refers to a market position in which you've sold a security that you never owned. In the stock market, selling a stock short requires borrowing the stock and paying a fee to the lending brokerage so you can sell it. In Forex markets, it means you've sold a currency pair, meaning you've sold the base currency and bought the counter currency. So you're still making an exchange, just in the opposite order and according to currency pair quoting terms. When you've sold a currency pair, it's called going short or getting short, and it means you're looking for the pair's price to move lower so you can buy it back at a profit. If you sell at various price levels, you're adding to shorts and getting shorter. Tip. In currency trading, going short is as common as going long. Selling high and buying low is a standard currency trading strategy. Remember, currency pair rates reflect relative values between two currencies and not an absolute price of a single stock or commodity. Because currencies can fall or rise relative to each other, both in medium and long-term trends and minute-to-minute fluctuations, currency pair prices are as likely to be going down at any moment as they are up. To take advantage of such moves, Forex traders routinely use short positions to exploit falling currency prices. Traders from other markets may feel uncomfortable with short selling, but it's just something you have to get your head around. Squaring up. Having no position in the market is called being square or flat. If you have an open position and you want to close it, it's called squaring up. If you're short, you need to buy to square up. If you're long, you need to sell to go flat. The only time you have no market exposure or financial risk is when you're square. Profit and loss. Profit and loss, P&L, are how traders measure success and failure. A clear understanding of how P&L works are especially critical to online margin trading, where your P&L directly affects the amount of margin you have to work with. Changes in your margin balance determine how much you can trade and for how long you can trade if prices move against you. Hey everyone! If you're enjoying our Forex Audiobooks channel, please help us out by subscribing to the Forex Sonic, liking any videos you find helpful, and sharing them with your friends or anyone else who might find them useful. We'd also love to hear your comments and feedback, so please leave a comment on any video you watch to let us know what you think. Thanks for your support. Margin balances and liquidations. When you open an online currency trading account, you'll need to pony up cash as collateral to support the margin requirements established by your broker. That initial margin deposit becomes your opening margin balance and is the basis on which all your subsequent trades are collateralized. Unlike futures markets or margin-based equity trading, online Forex brokerages do not issue margin calls, requests for more collateral to support open positions. Instead, they establish ratios of margin balances to open positions that must be maintained at all times. Here's an example to help you understand how required margin ratios work. Say you have an account with a leverage ratio of 100 to 1, so $1 of margin in your account can control a $100 position size, but your broker requires a 100% margin ratio, meaning you need to maintain 100% of the required margin at all times. The ratio varies with account size, but a 100% margin requirement is typical for small accounts. That means to have a position size of $10,000, you'd need $100 in your account because $10,000 divided by the leverage ratio of 100 is $100. If your account's margin balance falls below the required ratio, your broker probably has the right to close out your positions without any notice to you. If your broker liquidates your position, that usually means your losses are locked in and your margin balance just got smaller. Warning: be sure you completely understand your broker's margin requirements and liquidation policies. Requirements may differ depending on account size and whether you're trading standard lot sizes, 100,000 currency units, or mini lot sizes, 10,000 currency units. Some brokers' liquidation policies allow for all positions to be liquidated if you fall below margin requirements. Others close out the biggest losing positions or portions of losing positions until the required ratio is satisfied again. You can find the details in the fine print of the account opening contract that you sign. Always read the fine print to be sure you understand your broker's margin and trading policies. That's it for today, and thank you for listening to Forex Sonic. We hope you learned a lot from today's activity. The next part of the book will be uploaded in upcoming videos.